Nvidia, Meta, Apple, Microsoft. Do you know what they have in common? Yes, they've all delivered impressive returns this year, ranging from at least 30% to the north of more than 200% in a short 7 months. So you know what else they have in common? They are all monopolies in their own domain. And of course, I'm not talking about the board game Monopoly, but they all have significant market share in their own industry. And some of you might be wondering if there are other potential monopolies that are worth looking into. So you're in luck. At Piranha Profits, we actually believe in investing only in companies with a strong competitive advantage, only when they have a wide economic moat. And by extension, they tend to be monopolies in their own industry. So in this video, we'll actually uncover 2 hidden monopolies that are currently dominating in their own respective markets. After hearing our analysis, you can consider adding them to your watch list if you deem them to be opportunities. So before we continue, just to put out our usual disclaimers, our discussion here do not constitute a buy or sell recommendation, and despite our favourable outlook on the companies itself, it does not mean that it is a good investment opportunity for you specifically. Further, since business environments are dynamic, investors will need to have a pulse on the portfolio of companies that they own. So remember that a good company can turn into a bad one due to a multitude of different reasons. On the same note, a good company can also turn into a bad investment too, if you pay too high a valuation for it. So with that out of the way, let's talk about the first one on the list, BlackRock, with the ticker BLK. So I reckon that many investors have probably heard of BlackRock Incorporated before, but probably have not studied or even looked into them closely. So some might think that BlackRock sells ETF to the retail customers, some might even think that they help do M&As for big corporations, while some others might even think that they control the world. So what exactly do they do? So BlackRock Incorporated is essentially the world's largest asset manager with more than $9 trillion in asset under management. Yes, you have heard that right. 9 trillion freaking dollars. So I just need BlackRock, the CEO of BlackRock in fact, to notice me and give me 0.00001% and I'll be a millionaire. So that's the number of zeros that we are talking about. So today, some investors might be slightly turned off by that number, wondering how much more growth does BlackRock even have. Funny enough, despite BlackRock being the industry leader in the asset management space, they manage less than 10% of the global wealth, which suggests that there is still a large runway for growth. And the charming characteristic of investing in a global wealth management firm is the ability to scale infinitely alongside the global economy as more investors accrue more wealth over time and they just manage them accordingly. So on a retail level, BlackRock is the largest provider for exchange-traded funds, or ETF for short, as they've gained popularity over the years with more people being introduced to the idea of just passive investing. So on the other hand, BlackRock also has a respectable footing in the institutional wealth management space, which makes up half of their current asset under management. So at the very core, as Lawrence Fink, chairman and CEO of BlackRock, iterated in their latest earnings result, BlackRock is a company that provides a platform as a service strategy to deliver a better investment and technological outcome. How fanciful and how sophisticated. So they focus on delivering value-added services, solutions variety, and technological know-hows such as Aladdin, which is a portfolio management tool that many of their clients uses today. So many of them actually adopt and leverage on this Aladdin platform. Aladdin, amongst many other software, is a proprietary solution that helps with credit, risk analysis, stress testing, compliance, portfolio management, and many more. So according to a 2020 report in the Financial Times, the Aladdin software is deployed to oversee more than $21.6 trillion worth of assets globally. And let's not forget, BlackRock only manages 10, or less than 10. So Vanguard and State Street Global Advisors, who are the largest fund managers following BlackRock, adopts their software for portfolio management too. It's interesting, isn't it? Your fiercest competitors are currently also using your own software products too. So tell me about having an economic moat. Like any successful companies out there, BlackRock has also been ruthless in crushing their competitors. So they've made several notable acquisitions over the years, and one of them was back in 2019 where they bought eFront for $1.3 billion, which is a French startup that builds software with specific money management tools, which probably can be incorporated with their proprietary software. So of course, it doesn't harm to know that BlackRock has a proven track record of providing strong dividend growth over the last decade or so. So this further substantiates the market position and sustainable earnings power of the company. So you know what else doesn't harm you? Smashing that cute little like button, of course. So it shows great appreciation for the amount of hours that is spent creating the video. And I'm sure it will make my mom proud. Moving on to the second contender on this list. So I would reckon that most investors probably would not have heard of them before, unless you are in the IT or even the web development industry. And we are looking at VeriSign with the ticker VRSN. So at first glance, when you look at the stock performance over the last 2 decades, you might be intrigued by what happened to VeriSign in the 2000s. So for long-time investors that still recall the dot-com era, VeriSign was one of the prominent candidates that suffered greatly from the hype and subsequent bursting of the dot-com bubble. So an important lesson to take away from this is despite buying into a company with supposedly strong fundamentals and economic moat, you must do your independent valuation work so as to ensure that you do not overpay. So in VeriSign's case, it's a classic example where investors were caught up in the dot-com bubble and they only broke even after 20 years, assuming that they bought somewhere near its peak back in the 2000s. While that said, we are currently judging VeriSign purely from a fundamental perspective. So a quick overview of VeriSign's business. They're essentially the custodian of important digital domains such as .com, .net, .tv, .edu, and .gov. And these are top-level domains, TLD for short. So in order for you to have a better appreciation of VeriSign's business, you need to roughly understand how the domain name system works, or in short, DNS. And I'll play a short 2 minutes clip that explains it succinctly.
And DNS stands for Domain Name System. And DNS resolves names to numbers. To be more specific, it resolves domain names to IP addresses. So if you type in a web address in your web browser, DNS will resolve the name to a number, because the only thing computers know are numbers. So for example, if you wanted to go to a certain website, you would open up your web browser and type in the domain name of that website. So for example, let's use yahoo.com. Now technically, you really don't have to type in yahoo.com to retrieve the Yahoo web page. You can just type in the IP address instead if you already knew what the IP address was. But since we are not accustomed to memorizing and dealing with numbers, especially when there are millions of websites on the internet, we can just type in the domain name instead and let DNS convert it to an IP address for us. So back to our example, when you type in yahoo.com in your web browser, the DNS server will search through its database to find a matching IP address for that domain name. And when it finds it, it will resolve that domain name to the IP address of the Yahoo website. And once that is done, then your computer is able to communicate with the Yahoo web server and retrieve the web page. So DNS basically works like a phone book. When you want to find a number, you don't look up the number first. You look up the name first. Then it will give you the number.
So long story short, every website that you visit has a unique internet protocol or IP address attached to it, which serves as a unique identifier for anyone to access them globally as long as you have an internet connection. So the DNS system actually helps translate domain names into these specific IP addresses so that the browsers can load the different resources uploaded on the websites that you wish to visit. And users need not remember the convoluted and complicated IP addresses that are tagged to every single website out there. So VeriSign essentially operates exclusively for websites that end with .com and .net. And if anyone wishes to create a website with the TLD, they will need to pay VeriSign an annual fee. So considering the market share of different domain extensions, the moat is as wide as it can be. So even as an internet user myself, .com has become synonymous with the internet handle for every single website that I've interacted with thus far. So the appeal of VeriSign as an investment really sits on the inherent subscription-based business model. And trust me, there is probably a huge inertia for many existing businesses to switch over to an alternative domain. So on this idea of the subscription model, Retention rate on VeriSign's clients are astronomically high, and it's typically in the 70 to 80% range. So in a recent disclosure by their own management team, the highest cancellation rate is usually during the first year of domain ownership. So this is intuitive, as the goodwill and brand recognition of many of these new business websites might not be as entrenched. Therefore, many of these new businesses can still afford the switch. On the flip side, however, can you imagine if today a major company like Google decides to switch from google.com to google.ck or something along those lines? It would generate so much pushback and backlash and inconvenience to the multitude of internet users today. Therefore, this suggests that the moat of VeriSign is largely entrenched, as major companies would not or would never risk fooling around with their website. Unfortunately, we don't happen to have a crystal ball, so we can't say for sure which stocks will deliver the best returns in the coming decade or so. But if you so happen to have a crystal ball that can predict the future, remember to drop us a message. We are willing to pay a high price for it. Jokes aside, we think that both companies are fairly interesting given their current business position and on top of that, their competitive advantage in their own space. Now, despite feeling upbeat and optimistic about the future of both BlackRock and VeriSign from a business perspective, we believe that investors should only buy stocks when they provide a margin of safety. So for investors who want to consider the downside of these two companies, you can visit our blog at piranhaprofits.com where we elaborate on the potential risk factors that an investor might want to consider. The link will be in the description below. So for those of you who are keen on investing in these stocks and other strong potential opportunities, do check out our flagship subscription service, The Ultimate Investor's Playbook, where Adam Khoo has done deep dive analysis on the competitive landscape, the financial performance, and also the investment thesis and catalysts, and most importantly, the valuation framework around these stocks and whether they present a margin of safety or not. So link will be in the description below. So feel free to leave in the comments below what other monopolistic businesses are on your watch list. So this is CK from Piranha Profits signing off. Till then, keep winning.